but clearly we're seeing the shift already. The data that has come in on the inflationary side has been hotter than expectations and consensus, and the governors are taking notice. I think the FOMC will have to slowly kind of ratchet in its expectations that it can keep rates at the zero bound through 2023. We're already seeing potential for a rate hike by the end of next year, and the tapering then, if you just kind of work backwards, probably will also begin by the end of 2021, the end of this year, or perhaps at the latest early next year. Generally speaking, we also are looking towards that September timeframe, and I think Powell and team are as well. Keep in mind that's when the unemployment benefits roll off, and that's also when back to school happens. We get a better picture of the labor economy here in the U.S. and if there are indeed labor shortages to drive up wage inflation. And so, some data is still yet to be determined, but for now, I think on the margin, the trend for the Fed has been to kind of taper and raise rates a little bit earlier than maybe investors were thinking about.
David Kelly, did any of this surprise you, either in fact or in magnitude? The inflation forecast, the shift in the governor's expectations, any change in how you're thinking about this market based on any of this yet?
Yeah, I was pleasantly surprised because I think they did adjust to reality very well here. First of all, that is a massive increase in their inflation estimate for the fourth quarter of this year, but it's completely justified by the two very strong CPI reports we've seen since the last meeting. Second of all, they did put two rate hikes. We thought they might put one rate hike into 2023. They actually put two rate hikes into 2023. And then they also kept the unemployment rate down at 4.5%. So they think that the slowing that we've seen in labor force growth employment growth in the last few months, I think that reading between the lines, what they're saying is this probably is due to a slow reopening of the economy and because of these enhanced unemployment benefits. When those go away over the summer and in September, employment growth is going to pick up again, and that unemployment rate is going to come rattling down to that 4.5% target. So, both in terms of their forecasts and in terms of their rate hike projections, I regard this as appropriately somewhat more hawkish and, in line with a better economy. So I'm quite pleased with it.
John Bellows, what do you make, especially of this pop in the 10-year?
Chair Powell has gone out of his way in previous meetings to kind of de-emphasize the dots. Those are just forecasts. It's one of a number of events or scenarios that could unfold. And I wouldn't be surprised if he does that again today. I think that there's a lot of uncertainty right now about the outlook. There's questions about where the labor market is today, much less where it's going to be a year from now. Similarly, on the inflation front, it has been stronger, but a lot of that's reopenings and bottlenecks. It's hard to kind of read that through into next year. So, it sounds like the initial reaction is based on those dots. I guess I would really want to see kind of the language in the press conference because, again, those dots are just forecasts. It's one of many possible scenarios. And so my guess is Powell de-emphasizes those and instead focuses on what we know. And we know the labor market recovery is taking longer. And we know that the kind of reopening and bottlenecks is leading to some distortions in inflations. That's not a particularly concerning set of facts as we know them. Yes, there's reasons to get concerned about forecasts, but again, they're just forecasts. So I think that will be the message.
Shepard Smith here. Thanks for watching CNBC on YouTube.